Welcome to Escrow Out Loud, the SF Real Estate podcast from Jackson Fuller Real Estate. Experts on San Francisco real estate since 2002. Podcast notes with links available at jacksonfuller.com/podcast.
Hi, I'm Matt. Today is Friday, April 3rd. My guest today is a recognized leader in the mortgage banking and brokerage business, a longtime friend, and has been leading his bank's adaptation to lending in a COVID-19 reality. It is my pleasure to say hello to John Ebner with Opes Advisors, Flagstar Bank. Thank you for joining us, John.
Well, thank you, Matt, and thank you for such a nice introduction. It's rather a nice, long, poetic way of saying that I'm old. Maybe another poetic way of saying that would be to say that when God rested on the seventh day, having created the earth, I got busy trying to finance it. So there you are.
Well, not only perhaps are you old, or mature, as the jargon goes, but you're also good if you've been around that long.
Right. The gray beard.
So what's happening to buyers who want a mortgage right now, John?
Well, it's interesting. The mortgage marketplace is very fluid right now and changing much in the way that it started to happen in 2008. But in specific terms, I would say it really depends on what kind of mortgage you're looking for. If you are in the, I'll say, bucket for a loan that fits conforming guidelines, conforming meaning a loan that will be purchased by Fannie Mae or Freddie Mac, the two government agencies, much of that has been unchanged, or the changes that have occurred are being smooth. And when I say change, it's usually negative. Those are being smoothed out. For example, on appraisals, the conforming, if you're a purchaser, conforming guidelines now say that a desktop or even a drive-by is sufficient for their purposes, and they will buy the loan. So appraisers don't need to go into properties and do an interior inspection. So those are the sorts of things that conforming is doing. Government is similar, although they do have their own pricing problems. Government loans, that bucket being FHA or VA. Then you have what is the jumbo marketplace, and that's by and large what we do in our area, mostly because these loans exceed the loan limits that conforming does. And there you're really all over the map. Some lenders are going to still require that do these loans are going to be requiring full appraisals, interior appraisals. They're also going through changes in what they're doing. And when I say change, again, it's a negative, meaning they're contracting what they will do. So they're maybe lowering loan to values that they'll go to, meaning you have to come up with a larger down payment. They're raising the FICO scores, your credit score that you have to have. They're trying to mitigate what risk they have in a market that could go into a declining phase. So it really depends on what lender you're working with, and you have to have someone really good to help you sort through that.
To say the least, that sounds like the case. So in the jumbo marketplace right now, like talking about appraisals, it also sounds like one of the issues is the shelf life of appraisals right now, especially for people that were in contract. Do appraisals generally last 60, 90 days, or like banks tightening up on that as well? I mean, changing?
No, I haven't seen that happen yet. I would imagine it's generally right where you said, 60 to 120 days. I would imagine lenders may start to ratchet that down, not wanting an appraisal to be any lower than that. The other issue that may come up with appraisals is the box that says declining market might start to be checked. I don't know if that will happen soon because there isn't enough activity really to tell as yet, but that could happen as sales start to come back online in the months to come. So if that happens, then again, you'll see lenders requiring maybe a little bit more down payment upfront in order to do that. You also see lenders, if they are tightening up their guidelines. If they want more down payment, you may need to sort through doing what we did last time, and that is piecing together a first and a second loan. That seems to be one area we're already exploring pretty quickly, both on the conforming side to convert a conforming only loan into jumbo financing when you add a second loan, or with a jumbo product that will, expand how much money, how much financing you can have.
For 2020, what's the conforming loan limit?
We are, for single family, it is $756,300. Okay. $756,300.
And for a condo, do you happen to know off the top of your head?
Same thing. Okay. It's considered a single family unit.
Single family unit. Gotcha. You had talked about in the jumbo marketplace, lenders being all over the map and changing the rules. I've heard some reports of this happening not just before buyers go into contract, but while buyers are in contract and thought they had approval. So is that happening to buyers? Like, the rules are changing midstream, and is a financing contingency all the way to close of escrow a recommendation right now?
To be absolutely prudent, yes, to that final question. I think that would make the most sense. By and large, most lenders, if you have applied, you've gotten a conditional approval, meaning the underwriter has made their first pass at it, and they've given you a list of things that they still need to complete your loan, and you have locked that loan with the lender. Most often, if there is a guideline change to that loan product that you're on that with that change would make you no longer eligible, if you are locked, they will grandfather you into the old guidelines and they will close you that way. So you're usually protected with most lenders once you are locked. If you are all the way through underwriting, conditional approval, and you have elected not to lock yet, and you're still floating, you are putting yourself at risk of not getting the financing if there is a tightening of that lender's guidelines. So I would, if you see a rate that you can live with or you're excited about or anywhere in between, I would go ahead and suggest that most people lock. As we go through this process and get to the other side of this and things start to open back up again, you can always take a look at refinancing the loan you have. I think we will probably be in for low interest rates for quite a while.
So it sounds like for buyers, who are in the market right now, locking there's just another very good reason to lock your loan sooner rather than later. What are rates doing right now?
Well, conforming are pretty easy. They're somewhere in the lowish to midish threes for conforming loans. Jumbo is all over. You can find rates in the threes. You can find rates in that well exceed that, go into the fours, maybe some lenders with fives. And a lot of that has to do with the fact that there are multi-layers with mortgages and how they have a life after they are closed. Most people still think of banks and lending and their mortgage like the Bailey Savings and Loan, where it's being held by George Bailey. That is no longer the case. Almost every loan that's done now is going to be packaged with other loans, securitized, and sold in a marketplace to investors who want those as something to balance out their portfolio. That's what's done with conforming loans with Fannie Mae and Freddie Mac. And in private markets, that's what's done with jumbo loans. What is great about that, when everything is working well, is that it tends to keep interest rates lower because you're spreading the risk around. You also have very uniform underwriting guidelines, so all investors can take a look at loans and understand that they were well underwritten and they are a good risk. Right now, because of what's happening, you're seeing dislocations with that, which is why interest rates are jumping around all over the place. There are, especially in the private markets, those are shutting down where investors are not interested in those mortgage-backed securities whatsoever. I think that happened with Redwood Trust and some other outlets. So you're seeing a dislocation there. You saw it a little bit with immediately with the shelter-in-place order as those started to happen. That happened very much with Fannie Mae and Freddie Mac, and those markets tanked. What's great about the conforming market and why they are working so well now is the Federal Reserve is the backstop. They came in and they're backstopping Fannie Mae and Freddie Mac and buying those mortgages. They are the buyer of last resort. They are purchasing those mortgages and they are bolstering that whole marketplace. That's because Fannie Mae and Freddie Mac are also owned by the government. Private markets, that's another thing. The government is not backstopping those jumbo private markets.
So when I read an article and I hear that the Treasury is buying, implementing programs to buy billions of mortgage-backed securities, these are all conforming or Fannie Freddie. It's nothing to do with the jumbo market, which is essentially most of San Francisco lending.
That's correct. That's absolutely correct. Now, the fact that they are bolstering that side of the market does influence how the private markets are working. But there is no direct help from the federal government to jumbo lenders. Now, oftentimes, if you have a jumbo loan, if it's coming directly from a bank, keep in mind that banks are part of the Federal Reserve System, and as such, they can go to the window of the Federal Reserve and borrow money somewhere between 0 and 0.25%. So that they can keep their doors open or the window open, the lending window open to consumers for jumbo loans. So that's why you're not seeing a complete, shutdown of jumbo lending. It's still out there. And that's because banks can still go directly to the Fed and borrow money. Other lending sources may have a bit more of a problem, and those would be mortgage banking operations that don't have access to the Federal Reserve. They don't have depositors' money. They have lines of credit, and those can get disrupted in times like these, so that they have a harder time providing the jumbo financing.
So with so many moving pieces and various parts of this, I know you are a very smart guy. You watch markets and the numbers and finances in general, but are there any markets or reports or indicators you're paying more attention to or you think are particularly important right now?
Yeah, I have a couple of places that I go to, but they're more for industry. There's MBS Live and MBS Highway. Like I said, they drill down deep into treasuries, what's happening in mortgage-backed securities, and they also give a lot of analytics around that, which are great. And if anyone's interested in that, and I can share that with them, they can sign up for that. And if they really like it, then I want to hire them. But beyond that, I think there are a couple places that I go to. I go to CNBC. I find that a lot of their articles are nice and wide-ranging, even though they are ostensibly about business and the economy. I still think that they do a good job reporting worldwide. Like today, for example, I was reading about how Germany has dealt with the COVID-19 eruption and why they're doing better because their health system is run by the government. So they were a little bit better prepared. And you wouldn't think that that would necessarily be in a business setting, but it is because COVID and the health response to it and how governments are dealing with it do feed into what's happening with the economy, as is very clear to us all. So that's a good one. I think a really good spot to go to as well that's both entertaining and will illuminate you is this place called the Visual Capitalist. It will give you all sorts of charts and analytics and projections about anything. Right now, they are very heavy in COVID-19, and you can find all sorts of infection rates for different countries, where the numbers are bending down, where they're not. It's quite good and visual. It's heavy on the visual, so you'll see a lot of charts. That's one of my favorites, and it's called visualcapitalist.com.
Awesome. We'll include the link in the show notes. So for folks, I have some buyers that stay in the market and see this as a great opportunity. I have other buyers with a different risk profile that are kind of like, this is a great opportunity to pause while we see what happens. So for buyers that have moved to the sidelines or are, just waiting and watching, what should they do to be ready?
I think the best way to answer that is to say, going into our current COVID-19 world is different in the economic disruption that we're having, much different than 2008. In that 2008, as far back as 2006, you could start to see what was happening. There were those in the industry, in all sorts of industries, in the financial sector, that were starting to raise red flags and alarms about that. So it was kind of a slow roll. And then when there was a drop off late, September, October 2008, it still was month after month. There was a little bit more of people losing their jobs, et cetera. You contrast that to what we're going through right now, and the velocity of it is just head spinning. Within a matter of weeks or months, if you're counting back to, when China started seeing this in November, look at where we are. We've had, in 2 weeks, we've had almost 10 million people go in and make a jobless claim for unemployment. That's absolutely unprecedented. It doesn't even begin to describe it. So that doesn't necessarily mean we'll come out of this with the same velocity, but it doesn't either mean that we're going to have a really, really slow recovery. I think that what will happen is the sooner we can get to the other side, the sooner we do all this social distancing, do it together, and really tamp down the transmission of the virus, the sooner that we can go back to life as normal, and the recovery will be more rapid, certainly more rapid than what we had in the last go around. So for borrowers who are waiting for that, and we could be measuring that in months, we could be measuring that in about a year, somewhere in that range. I think there will be some changes. I think people will be a little bit more cautious with their money. That often happens when you go through this kind of economic disruption. But for people who are going to be interested in buying at that point, probably the most important thing is to keep your credit score high as best you can. I know that may be difficult if you are a current homeowner, need to go through some forbearance with your mortgage, that sort of thing. Those things won't be reflected on a credit report, is what we're being told. And Congress has been very clear that you can't report that as a lender to a credit reporting agency as bad credit. But other than that, you want to try to keep your credit scores good. Lenders are going to still probably be conservative as we start to come out of this. Assets, the same thing. I would not be doing anything with my credit, either closing accounts or paying things down. I think you should, not only for borrowing for a mortgage, but going through this COVID-19, keep your assets high and dry and available. That's probably the most of it. I would imagine that there are going to be, like I said, lenders who will come back into the marketplace and be ready to go with jumbo financing much faster than we saw in the last go round with 2008. You have to remember that deep down, there's nothing wrong with our economy. There are some things that maybe are a little bit out of whack. But unlike 2008, where there was real rot in the economy that was brought about by banks and Wall Street being crazy about lending and not watching, the credit markers, that's not the case here. If anything, especially in the mortgage industry, we have had a very, very clean run for over a decade of very buttoned down underwriting. So intrinsically, there's nothing wrong with the lending itself. We are doing this somewhat voluntarily, dismantling our economy on purpose in order to save lives and to stay healthy. And as we do that and we come out on the other side of it, we can very likely pick up the pieces a little bit more quickly with our economy and put it back together. That will be helped with more backstopping by Congress, keeping people in their jobs, keeping people flush with cash, some relief with not having to pay rent, not having to pay mortgages. All of that stuff will ultimately help. And I think we'll be able to pick up when we get on the other side of this.
So one final question for you. You kind of touched on it just now. We've been talking about the future and people trying to get a loan right now or thinking about getting a loan in the future. You've done thousands of loans over the years. For the folks that are reaching out to you, like, I've lost my job, I'm freaking out. Do you have any advice to folks that currently have a mortgage in terms of approaching their lender about forbearance?
You can, your lender is your servicer, the person that you contact or the entity that you contact that you make payments to. If you feel that you need the forbearance so that you don't, if you know that you're not going to be able to make payments, you don't want to go into a default status. You want to take the fact that you won't be making payments and make it a forbearance status. So you do want to contact your lender. You do want to tell them that you need forbearance. I believe they require a letter from you as to what the reasons are behind it. There aren't a lot of requirements that Congress set out that you have to do this. You don't have to be jobless. You can just see a decline in your income sufficient for you not to be able to make payments. By and large, now this is just starting, but by and large, I don't think people should experience much of a pushback from lenders or their lender for getting the forbearance. If you do, because lenders don't want to do this for reasons of their own, if you do get a little pushback, push right back and say, look, Congress said that I can have this. I need this and I want the forbearance. So let's just cut to the chase and go into that status. Tell me what you need. I'll send it to you and get it.
And to be clear, forbearance is not a dismissal or a waiver of a payment. It's just delaying it with no interest or penalty, correct?
That is absolutely correct. And there will be there are three ways to handle it on the other side. Right now, the way the legislation is written, you can have up to 12 months of forbearance, and it's done in two steps. You can have 6 months and then re-up for another 6 months. At the end of that, you can either pay everything back all in one lump sum. That's probably not what most people will be able to do. The amount that has been forbeared can be spread over a period of time that you can work out with the lender. You can say maybe over the next 18 months, amortize that amount that I was given forbearance on and make my payment higher so that I can catch up in 18 months. Or you can do a formal modification of your loan so that it is extended out. So if you have, 27 years left on your loan, maybe it will become 28 and a half years as a result. So those are the three ways that you will do it. But you are absolutely correct. There will be no negative credit reporting. There are no late fees or added interest for not making any payments.
Not that you can give financial advice, and everyone's situation varies based on their unique circumstances. But in general, is it a good idea just to request a forbearance at this point in terms of cash conservation, or do you kind of feel more like if you're in a position to make the mortgage payment and you've got your cushion, go ahead and do it?
I've got there's an angel on one shoulder and a devil on the other. So the angel would say, I'm not sure which one would be the angel, but one would say, go ahead and make your payments. If you have the wherewithal to do it, keep your payments up. You're going to owe that money anyhow. So if you do have the very strong reserves, if you are in a job that is not going to go away, in particular in this COVID-19 era, and in fact, some jobs, especially in healthcare, certainly are not going to go away. You will always be working, maybe many more hours than you wish. If you're in that category, then go ahead and continue to make your payments so that you don't have to figure out how to catch up later on. But at the same time, and there's a reason for that. Industry-wide, if a lot of people go into forbearance, that in and of itself is going to feed into some disruption with the mortgage industry. And that's because whoever you're paying is usually just a servicer and not the owner of the loan, not the investor. And they have a contract with those investors that even if someone stops making payments for whatever reason, even if it's forbearance, that servicer still has to make payments to the investor as if they are collecting payments, and they still have to make payments to the county if they're collecting taxes. So that's going to cause somewhat of a disruption. So if you can make your payments and you are strong in reserves, strong in your job, go ahead and do so. If on the other hand you are, and I'm not going to stress this enough. If you don't feel that your job is secure, if you don't feel like you have the reserves to maintain it, then and you think that you may be losing your job, then really keep an eye on asking for forbearance. I wouldn't do it until you know that you're going to be dismissed possibly, or until you know you're running out of reserves and the amount of money you're making right now is just not going to do it. Ask for forbearance. Remember, it only lasts for 6 months at a time, so you don't want to pull the trigger too quickly, but ask for forbearance before you go into a default status, being late with your payment. That will be reported on your credit report if you're not in forbearance. So don't wait so long as to allow that to happen. Go ahead and request the forbearance from your servicer well before that.
So it sounds like you're saying very much, don't wait for this to be an issue in the rearview mirror. If you know it might be an issue, call in advance, get the forbearance. That's a whole lot easier and cleaner to deal with than attempting to clean it up because you missed a payment or were a couple days late.
Absolutely.
Does forbearance only apply to owner-occupied mortgages, or what about investor properties or secondary homes?
At the moment, if those entities that own loans that are qualified for forbearance would be if you have a conforming loan, if you have a government loan. Jumbo lenders are not required to offer forbearance, so that would be a whole different kind of conversation that you'd have to have with a lender. You may want to ask for forbearance. Maybe they'll give it to you. Maybe it makes sense for them to do so along with the other. But to answer your question specifically, no. It can be a rental property. If it's a conforming loan, you can still get forbearance on it. If it's a rental property, you can get it. If it's a second home, you can get it if it's a multi-unit property, as long as it's a conforming loan. So if you are an investor, a small investor that owns a 4-unit building, and you have maybe some tenants that have left, and now you can't show the property, no one's interested in moving around or going into a new place, and you know that there's no way that you can maintain those payments because you do depend on the rent income from that, then you can request forbearance on those as well. So it's not just for owner-occupied, it's for investor-held property, second homes, any of those.
Right, and also not just in landlords that have vacant units, but there are going to be plenty of renters who aren't able to make rent, not only this month, but in the coming months. So if you're making your debt service payment requires on rental income, forbearance sounds like a pretty important thing to be aware of.
Yeah, absolutely. It kind of makes sense to, I think the approach across the board by policymakers is to treat this differently, because we're not in a kind of moral hazard of just walking away from our commitments. This is a health crisis that has brought economic distress to us at the same time. So I think the approach here is to try to keep everything together as much as possible by doing things like forbearance, not letting things go to default, to foreclosure, to all of that stuff. Going that route collectively as an economy means that we will have a bigger hole and a longer stretch of time to dig out of it, as happened in 2008. If we just grant the forbearances, if we go through this, increased unemployment, or even keeping people in their jobs and having the government, which could happen. That's what Europe is doing right now. Keep people in the jobs, keep them flush with income, the income that they were enjoying before this. That it's a much quicker turnaround on the other side of this. We can pick up more quickly on the other side of this if we're all kind of staying in place, and the disruption will be less. Yes, we'll have a bigger national debt through it all, but that is a problem we can deal with on the other side of this, as far as I'm concerned.
I would completely agree with you. So every time I talk with you, I learn at least one thing. And I think today I've learned at least a dozen things. So my head is about to explode here. I also know that when you agreed to this, I promised 5 to 10 minutes, and we've been a little longer than that. So thank you so much for joining us. Anything else you want to say or last thoughts before we wrap it up?
Not really. I mean, I would if you're still in the market for real estate, and have means to take a look at property and make an offer on it. I always say that these are the times that are when it's the adult swim. I know it's you're in the deep end, but this is the adult swim. If you can acquire real estate at this point, when there's some contraction, you're probably going to get quite a good deal on the purchase that will do you well on the other side if you have the means to do it with down payment and being able to qualify, et cetera. So I certainly would not take it off the table because there are some good deals to be had out there right now. And the same is true for financing. There are still outlets for getting financing. So yeah, I would if you are one of those that see this as an opportunity, then stick with it and look for real estate and get into contract.
Awesome. Agreed. I so appreciate your time. And for everyone that's listening, if Mr. John Ebner is the super smart kind of lender you want to work with, his email is jebner@Opes, OPESADVISORS.com, jebner@opesadvisors.com. His phone is 415-869-6101. And thanks again, John, for joining us.
You're very welcome. Thanks for having me as a guest.
You've been listening to Escrow Out Loud, the SF Real Estate podcast from Jackson Fuller Real Estate, experts on San Francisco real estate since 2002. Podcast notes with links available at jacksonfuller.com/podcast.